guys, welcome to the Juniper Links accounting channel. My name's Caroline and today we're going to look at directors' loans and things you should know before you take them. So without further delay, let's jump into my computer and get started. All right, let's get started with the video. So I'm going to explain what directors' loans are and also some things to keep in mind if you are considering doing this. Okay, first off, we've got types of loans, and this is some of the circumstances where a director's loan can be created. So the very first one is just a standard loan arrangement where you've decided to borrow some money from the company and you've agreed to pay it back within a certain time period. So it's pretty normal. And this is assuming you have not taken too much money so the company cannot pay its taxes. So the next type is beneficial loan, which is an interest-free loan over £10,000. So if you were to either take too many dividends or you've taken a director's loan but it's more than £10,000 and it's interest-free, so this is the key, then you would need to basically receive a benefit in kind from your company and pay taxes on that benefit. The third type is an overdrawn director's account. This automatically creates a director's loan because you've taken too many dividends, otherwise known as illegal dividends, from the company. This means the company can't pay its taxes. And this type of loan should definitely be avoided at all costs because it's just going to create a lot of hassle, a lot of problems. You're probably going to have benefit in kind payable if it's over 10,000, unless you pay the interest, of course. But the key thing here is that you'll get into a lot of trouble personally because the company can no longer pay its tax bill. So moving on to the next slide. What is a director's loan? So you, the director, are receiving a loan from your own limited company. That's essentially what a loan is. This can be interest-free up to £10,000 without creating a benefit in kind. An overdrawn director's account automatically creates a director's loan. So like I said, if you take too many dividends where the company doesn't have enough profit for those dividends, then you automatically get a director's loan and it has to be reported accordingly if it's over the 10K, or later on a corporation tax deposit has to be paid, which I'll get into in a minute. So overdrawn accounts should be avoided because there's not enough money for taxes. And like I said, HMRC could hold you personally responsible for the company's taxes if you've been negligent in that way. What is a beneficial loan? So beneficial loan is an interest-free loan that is more than £10,000. This can arise from an overdrawn director's account or illegal dividends, like I said. And if you don't pay interest, a benefit in kind will need to be reported on a P11D at the end of the tax year. So in this case, it's like you're receiving a taxable benefit in kind because you have an interest-free loan over a certain value, which in this case is £10,000. So I'm going to start out with the cons of a director's loan and then move into the pros later on. I think it's a nicer way to go about doing it. So if a loan is not repaid before the corporation tax, so this is CT is corporation tax. So if the loan is not repaid before the corporation tax deadline, HMRC wants a 32.5% deposit. I will explain this in more detail further in the video, so just hang on a second. The corporation tax deposit is refundable, but only up to 4 years after the accounting period is ended, when the loan was first declared. The company may not have enough money for tax, so HMRC can hold you personally liable for those if there was negligence involved in running basically managing the funds of the company. And this is the overdrawn director's account, like I mentioned. And another last one is require some paperwork for a loan agreement or P11D for the benefit in kind. So if you wanted to arrange the loan with your company and you wanted to put specific terms in place and also the rate of interest and all of that stuff, then you would have some paperwork to do on that. P11D is standard paperwork, basically to declare your benefit in kind if you're not going to be paying that interest to your company. Pros of a director's loan. So you have the ability to take an interest-free loan of up to £10,000. So this is actually really pretty sweet in my opinion, because that's much better than you'll get with a credit card provider. Let's say if you wanted to borrow some money but you didn't physically want to receive that as income. For example, you wanted to purchase something like like a car, and you wanted, like, your company has the money to do it, but you wanted to rather like pay monthly repayments towards that 10K amount, then great, that is a really good way to do it. Obviously, it requires some management, but if you can do it, then that's good. Over £10,000, the interest is relatively low at HMRC's official rate, which this year is 3.25%. And interest paid, this is a really good pro actually. Interest paid into the company is added as income for the business. Obviously, it's not trading income, it is financial income. But effectively, the money stays within your business, meaning like if you were to take a loan elsewhere with the 3.25%, let's say, or higher even, or less, who knows, basically that money is gone at that point. By keeping it within the business account, then all there is payable on that is the corporation tax at 19%, and it's only the interest portion that is received as income. So it's like, although you have to pay interest to yourself to prevent creating a benefit in kind when it's over 10k, it still stays within the business. So actually the amount you pay for that loan is not very much. Basically, if you want to maximize a loan, then it's best to take it from the beginning of your accounting period for the company accounts, because that way you'll have the most time before that needs to be repaid and the corporation tax deposit is applied. So this corporation tax deposit is for directors that have a material interest in the company. So if you own a certain amount of shares, then you're going to have a material interest. In most cases, for example, if you're contracting or providing consultancy services or freelancing through your own company, you will be having a material interest in your company because you'll likely be the only shareholder. And that means there will be the corporation tax deposit on any loans you personally take from the business. Moving on, the two main effects of a director's loan is benefit in kind. So that's when you pay personal tax on the value of the benefit received. And this is only on the loans that are more than £10,000 and you don't pay interest into the company. Corporation tax deposits are loan outstanding at the company year end. And if they're not repaid before the corporation tax deadline, HMRC will want you to pay tax on that money, and they'll hold it until you pay the loan back fully. And I'll explain this a little bit in another section here, just 1 second. Firstly, we'll just go over how to prevent the benefit in kind for your loan. I've mentioned this a few times now. You would need to pay interest at HMRC's official rate on the loan, which is straightforward enough. You might just want to get an accountant or a tax advisor to help you with setting that up, just to make sure you're doing it correctly and making all the calculations of the interest correctly. You must physically pay interest into the business account. So you can't just say, here's the interest charge for the year, I'm expensing that and I owe that money to the company. No, it doesn't work that way. You physically have to repay interest into the business account from a personal account. Or another option, which is a fairly straightforward one, if you can help it, is just to not take a loan of more than £10,000. There will be no benefit in kind and you don't need to pay interest. So those are some ways to prevent that from happening. Obviously, the last one is pretty self-explanatory because you're just not receiving that loan benefit. So there's no need to account for that. What is a corporation tax deposit? So this is a more recent thing. Not that recent now, but it has been a more recent change where HMRC wants you to pay 32.5% of the loan value outstanding at the company's year-end date. And it can be outstanding, but what you can do within the 9-month period after the company year-end date, you can repay some of your loan or even all of it and basically say to HMRC before you submit a corporation tax return, or if you've already submitted it, create an amended return to update the amounts repaid, and you'll only pay 32.5% on the amount still outstanding within that 9-month period. So you could pay back the full loan 3 months after the company year ends, and you won't have a corporation tax deposit because you've repaid the loan in full. So HMRC simply increases your total corporation tax bill with this amount. It's obviously marked separately on the actual return, just to track it, but basically the whole corporation tax bill just is added together. So HMRC will charge interest on the outstanding deposit, which is non-refundable. This only happens if you have a 32.5% deposit, let's say it's £1,000, and you don't pay it before the corporation tax deadline, then HMRC will charge interest on this value. So that's just something to keep in mind. If you don't pay the deposit, there will be interest charges on that deposit. until the loan is fully repaid or you've paid the deposit. So take your pick. The actual deposit can only be refunded once the loan is fully paid back to your company. And there are some rules around this, which I'll get into in a second. And you have 4 years to reclaim the deposit. So from the company year-end date that it was first declared in, the actual loan, you have 4 years to reclaim that. And that's generally the rules of directors' loans here and possible implications that you might want to watch out for as a single director. But this is kind of where that 21 months come in as a maximum timeline of taking a loan. That's like you take the loan at the very beginning of your company's trading year. If you took it at the end of the year, so let's say you took that loan on the 1st of February and your year end is the 31st of March, then you've only got just over 9 months to repay that loan. Otherwise, you have to pay this deposit because it was declared within that accounting period ended March. So that's kind of like the timeline and everything of how this works. And this was brought into place to basically stop directors from taking loans on an ongoing basis with having to pay any kind of tax on it or benefit in kind or anything like that, but they never bothered repaying it to the company. It would just keep going on and on and on. And then they were like, okay, you need to declare any loans outstanding to the director. Any loans provided to the director that are still outstanding at the end of the year end. They need to be disclosed in the accounts, and also there needs to be like the details of how they're repaying it and how much interest is being charged and all that kind of good stuff. So those rules were added in to basically avoid directors taking money from the business without being taxed on it personally. This just so happens, this 32.5%, just so happens to also be the higher rate tax for dividends. And you can kind of see that they're basically being like, okay, if you take a loan from the company over a certain time and you've not repaid it, then you're going to have to pay us this extra money until it's fully repaid. It's basically HMRC is trying to stop people from taking advantage of the loan scheme through a limited company and not paying taxes, basically. So that's why they've limited it. It's kind of unfair for people that have legitimate reasons to take a loan from their business and do pay the interest and everything and are paying it back and just needed, like, let's say a 24-month loan. It's a bit unfair for those people who are actually doing it properly. But for the most part, it's meant to stop people that are abusing the loans from your own business. And this leads me to my next point, which is called bed and breakfasting. So this is essentially when you pay a director's loan back with the intention of taking it again. They've put a flat 30-day rule on it to make sure any loans that are paid back and then taken out again within 30 days are just considered still outstanding. HMRC would not allow you to class that loan as paid back and a new loan taken out. It's bed and breakfasting, basically. So you're just doing it to reset the time and then carry on taking your loan, which doesn't fly with them so well. So within 30 days, you cannot take another loan and it be paid off. If the intention is still to retake it, even after the 30 days, then you can still be caught doing bed and breakfasting. Now, obviously, the chances of this happening are, proving the intention is quite difficult because nobody's in your brain being like, you had that thought when you were taking the loan. But essentially, if it's a pattern, HMRC will pick up on it. They'll see that you pay back the loan and then you eventually take it out again, and it just keeps happening, and they'll be like, you intended to take this loan, you've done it every time, what are you doing? You can't do that, you need to pay that to the company and pay the appropriate taxes and everything like that. So bed and breakfasting is something to keep in mind if you do have the intention of paying the loan back and you did pay it back, and let's say 60 days later you're like, I need to borrow some more money for this purchase I'm making, and it would be beneficial to do it through the company, then you didn't have originally the intention of taking that loan out again. It just happened that it worked out that way, and in which case it wouldn't be classed under bed and breakfasting, but it's all about the intention on whether or not you were going to take it again. So recap on directors' loans. Just wanted to highlight a few points about them. So they can be very useful, just need to be managed properly. So loans arising from illegal dividends means the company can't pay its taxes. This is where the management comes into place. If you took a loan that was created from illegal dividends, HMRC can hold you personally liable for poorly managed company funds. So keep that in mind. Loans are not something to play around with if you've not got the company money for it. So it's easier to pay the interest on a loan over £10,000 than have a benefit in kind. In most cases, this is true. And also, why pay the benefit in kind taxes to HMRC when you can keep the interest income within your business and just pay the 19% corporation tax on that interest? So you kind of keep the funds in-house, even though they're just going back into your company. It's better than just paying extra tax, which you're never going to see again. So that's kind of something to keep in mind. Loans taken at the beginning of an accounting period can have longer repayment terms, which the corporation tax deposit applies 9 months after the company year-end date. So the earlier you take the loan within an accounting period for your company, the longer you'll have to repay it, because the corporation tax deadline is 9 months after the year-end date. So you can maximize the time scale by taking it out sooner. Obviously, the more time passes within your accounting period, the less time you'll have to repay the loan, and you will have to pay that deposit if it exceeds the deadline. So that's kind of my quick tips on director's loan and what effects they have. Thanks so much for watching till the end of the video. I hope you found it really helpful and clarified some things about director's loans and what it might mean for you and your company. If you did have any questions, feel free to leave them in the comments below, and we'll get back to you as soon as we can. If you liked the video, please click that like button, and also don't forget to subscribe for more content like this, and we'll see you in the next one.